Hi, I'm Tom Siomades, Chief Investment Officer at AE Wealth Management. The first half of the year has gone by in a flash, featuring a tumultuous first quarter and a second quarter marked by major growth in the markets. As we move into the third quarter, let's take a moment to discuss how the second half of this year may play out. The first half of the year was a wild ride, with a new administration taking office, vaccines becoming more widely available, and the economy reopening in fits and starts. The next question is, what's the next big thing to move markets, and where's it going to come from? Inflation has begun to be a bigger and bigger concern beyond just the transitory phenomenon that Federal Chairman Jerome Powell has pronounced it will be, just as the economy hits full stride. The equity market has continued to struggle off inflation concerns, and the bond market seems to be discontinuing a rise in rates as the yield on the 10-year Treasury hovers around the 1.5% range. The consumer has been strong and spending has been up, fueled by pent-up demand. Over the last few months, we've heard more and more about inflation, and consumer spending has actually begun to flag. We need to see if it can be sustained come this fall when much of the stimulus support is removed. Job growth has also been strong, but there are still complaints from businesses that they cannot find workers. Whether that's from continuing enhanced benefits from the government or other reasons that are preventing people from returning to work, such as a lack of childcare or the fear of infection, the economy is just not open fully yet. As benefits roll off this fall and kids are back in school, that may change, but in the meantime, it's a headwind. Overall, the first half of the year has been really strong, but it's time to focus on the road ahead. To me, there are a lot more unknowns right now, and I find it hard to be very exuberant about the second half of 2021. Given the lack of anything big, new, and shiny coming out of Washington in recent weeks, it would be difficult to expect markets to confidently march forward from here. So far, the only big spending scheme that has passed was the $1.9 trillion stimulus. Agreement on the infrastructure bill, officially the American Jobs Plan, the American Family Act, and the $6+ trillion budget seem to have bogged down. It begs the question, if markets ran up on these expectations, what happens if they never come to be? The vaccine trade is pretty much done at this point, and with approximately 45% of the country vaccinated, it appears reaching a rate much above 50% is pretty slim. Q1 and Q2 were both strong, but I believe we will see a deceleration as the year progresses. So what does that mean for the months ahead? As I said earlier, I think markets will be challenged to go higher. I've spoken about concerns of inflation becoming a reality, and last quarter those fears got real. Inflation will likely hang over the markets over the summer, potentially leading to a turbulent and volatile third quarter. In my view, it's naive to think that inflation is transitory and that it will subside as supply disruptions are cleared up. Companies will get used to getting more for their products because customers have shown that they're willing to pay more. And unless we see a corresponding rise in wages, people will have to get used to paying more for less. Last quarter, I shared that my biggest concerns were that the administration or the Fed would make policy mistakes. Inflation fears turning into reality, or the market feeling current prices will not be supported, all of which would lead to a rocky second half of the year. So far, exorbitant spending proposals and overly generous benefits have, in my view, been a mistake on the part of the administration. As I see it, they should not have flooded the economy with cash and should have allowed it to open earlier and on its own. I also believe the Fed is making a mistake by assuming that inflation is transitory. It's transitory until it's not, and it will be too late by the time the Fed acts. The markets, which at this point have mostly ignored those flashing yellow lights, will not take kindly to these developments in the second half of the year. At some point, they will realize that this path we're on is not sustainable, and we're overdue for a bit of a correction. So what should investors do to prepare for the second turbulent half of the year? Long term, I can't stress enough that you'll be fine if you're positioned appropriately and you have a solid allocation and a plan based on goals. This is a great time for you to connect with your advisor. Do an investment math check and make sure you're on the right path and on your way to achieving long-term goals. Please enjoy the summer. Thank you for your time. Take care, be kind, and get out there and enjoy some of this warm weather.